Good afternoon, everyone. JR with Secure Metals with your technical look at both gold and silver. Today is Monday, June 24th, 2013. It is 3:57 p.m. Eastern Standard Time. Before I get into the analysis, which I'm also going to do an analysis of the Dow Jones as well. But before I get into it, I just wanted to go over some of the things that have been happening in the last couple of days. A lot of excitement. If you are watching this video, you're one of the survivors. Really, the market as a whole has seen a giant sell-off. Equities across the board, commodities across the board. Asia, Europe, Australia, every market has been in the red since this little Bernanke speech, okay? In China, actually, the Shanghai Composite actually saw the biggest drop in the last 4 years. Again, like I said, Europe is down, Australia is down. Really, every country is down. Emerging markets are down, which is not good for the long-term outlook here for us. Okay. The benevolent hand has once again touched the market, and now the market is looking for balance. I don't think it was a bad thing that Bernanke came in and spoke last week, even though he did create a lot of chaos. A lot of times this chaos just really means a balance. Is really just the market trying to balance itself out from all the distortion that the Feds have created. All right. The global market sell-off turned out to be a little bit more than just a knee-jerk reaction, which is really what I think most traders expected. Just a quick knee-jerk reaction, similar to the ones that we've been having every time we see one of these FOMC meetings. But again, it wasn't just that initial knee-jerk reaction, okay, to this Bernanke speech. 2 days after the speech, this is what Bernanke's colleague, St. Louis Federal Reserve Bank President James Bullard, on Friday issued a sharp rebuke of his colleague's decision this week to announce a plan to reduce the central bank's buying, calling the move premature and worrying the Fed is risking its credibility as a force of price stability. Worrying the Fed is risking its credibility. Let's look at this credibility here real quick. So this is Keynesian theory of economics.
Ben, there's been a lot of talk about a housing bubble, particularly, from the Fed, from all sorts of different places. Can you give us your view as to whether or not there is a housing bubble out there?
Well, unquestionably, housing prices are up quite a bit. I think it's important to note that fundamentals are also very strong. We've got a growing economy, jobs, incomes. We've got very low mortgage rates. We've got demographics supporting housing growth. We've got restricted supply in some places. So it's certainly understandable that the prices would go up some. I don't know whether prices are exactly where they should be, but I think it's fair to say that much of what's happened is supported by the strength of the economy.
Tell me, what is the worst case scenario? So we have so many economists coming on our air and saying, oh, this is a bubble and it's going to burst and this is going to be a real issue for the economy. Some say it could even cause a recession at some point. What is the worst case scenario if, in fact, we were to see prices come down substantially across the country?
Well, I guess I don't buy your premise. It's a pretty unlikely possibility. We've never had a decline in house prices on a nationwide basis. So what I think is more likely is that house prices will slow, maybe stabilize, might slow consumption spending a bit. I don't think it's going to drive the economy too far from its full employment path, though. I'm hopeful that, and I'm confident, in fact, that the bank regulators will pay close attention to the kinds of loans that are being made, making sure that underwriting is done right. But I do think that this is the most...
So again, I'm not going to bore you with 10 minutes of Keynesians versus Austrian, but I can tell you this, that the credibility that this guy is talking about, I don't even see it. I really don't see it. They didn't see the dot-com bubble. They didn't see the housing bubble. They really don't see these bubbles. I don't know if they don't see it, or I don't know if they realize that they're really the corporate of, they're really the ones creating these bubbles. So again, distortion really is what creates these bubbles. When you have these Keynesians come in and they distort the market, really they make markets do what markets don't want to do. And what happens is you create these bubbles. And of course, when the market tries to balance itself out, you have these huge burstings of these bubbles. And again, this is really what we're talking about. This is what we see. We see this guy printing money, and I don't know that he realizes what he's doing. So, at any rate, I don't think there needs to be a big reason to panic just a few days before the drop, I think I said on a previous video to reduce your exposures to equities. I think right now is not the time to be chasing markets. What you have to do is make educated decision, diversify your portfolio, and you should be okay. Okay. Like I said, reduce your exposure to equities. Right now, we're on a no-growth economic environment. Really, nothing is out there supporting these equities. I say is take advantage of the dips. Anytime you get a dip, buy more. Be careful while doing it, though. Okay, but I think right now, between now and the next couple of days, is going to bring good buying opportunity. There's a tremendous amount of distortion in the market. Central banks are printing money left and right. It doesn't look like there's going to be any end of QE, at least not anytime soon. The current sell-off cannot continue. If it does, then Bernanke's just going to have to step on the gas again. All right, he's just going to have to get more aggressive with his policies. He's already made note of this in his last FOMC meeting, which was last week, and in all previous meetings, he said in his testimonies that he is willing to accommodate more if economic conditions worsen. And he still needs to deal with his mandate of 7% unemployment by the end of the year. Actually, if it's not met by the year's end, tapering will be less likely to happen. But for some reason, the markets are not listening to that. They're just hearing tapering. And when they hear the word tapering coming out of Bernanke's mouth, I think everyone panics a bit and starts to sell. And obviously, I think the global economy is a reflection of that sentiment. These times, guys, these are the times that we don't want to get too aggressive. We want to be smart about our investments. We want to be very well diversified. So please make sure that you're not chasing the markets, but take advantage of the dips, because we still have a lot of room to go, both on the equities market and on the commodities market as well. All right. As far as gold and silver, now, before I get into gold and silver, I wanted to talk about the knobs. Obviously we talk about liquidity, we talk about money, and we talk about the economy as a whole. So we're talking about an economy that's controlled with interest rates and money supply. And those are the two tools that the Federal Reserve uses, okay? You have the first knob, which is your interest rate. You have your second knob, which is liquidity, which is money supply, right? Now, interest rates are already near zero, okay? So Bernanke will be forced to use the other tool that he has, which is the money supply. On Wednesday, when he spoke, he gave an analogy of a car. You're driving a car and you're injecting money in the system. Would be kind of like injecting gas into the engine by pressing the gas. All right. Interest rates would be the brakes. When he made very, very clear, that he is not looking to hit the brakes anytime soon, at least not to the end of 2014 or 2015. Okay. He also stated that he expects the economic conditions to continue to improve at a moderate pace. Which again, I don't even see where he says that, because really we've had a contraction this year, not an improvement. We've seen some support in the housing market, but that's again because they're channeling a lot of money with these interest rates down to zero. They're channeling more money to the housing market, and if you ask me, I think we're going to see another dip in the housing price and housing prices. Especially last week, you saw the yields go up. Okay. Now, his target for unemployment is 7 and 7.25% by the end of the year. He stated that if we do not see unemployment at 7 to 7.25%, he will continue without any tapering. Meaning, he's going to continue to buy these $85 billion worth of purchases without tapering. Okay. Again, like I said before, for some reason the market only hears tapering by year's end, though. And I think that's really what caused the sell-off. Okay, so what is the goal by printing? Well, at this point, you cannot lower interest rates anymore. All right. Then there's printing. All right. So by printing money, the value of the dollar would decrease, making it easy for developing countries to come in and buy our products, and actually countries all around the world to come in and buy our products, as well as the psychology of inflation setting in. This will force people to contribute in the support of the economy, because if they don't, their dollars are just going to get wiped away by inflation. Okay, and what happens when they don't, when the Fed does not get the results that they're looking for? Well, I don't think we need to do a lot of soul searching. I don't think we need to go. We don't need to break our heads thinking about what's going to happen if these guys don't meet their mandates. It's very easy. Bernanke has already stated that they will increase the asset purchase programs if conditions worsen. Deflation is what they're trying to fight, and that's what they're getting. So he's made it very clear that if we continue with this deflationary period that we're going through, he is going to step it up here. Okay, I'm predicting that quantitative easing will continue. We might see some tapering, but ultimately I think we realize what the market will do the second they start to taper. This is what happens. You have a global sell-off. You have the ripple effects stretching all over the world because of because he mentioned that he might taper in 6 months from now. So this is what happens when he talks about tapering. I'm looking forward to the day that he actually starts to taper. Okay. But ultimately, I don't really see that happening. All right. Again, you might do a little bit of tapering, but also, I think the economy is a druggie that needs more drugs, and without the drugs, he's not going to be able to function. All right. He also mentioned that inflation goal is at 2%. All right. And he's not getting it right now. He's at 2%. He's at 1%. So that right there will give him a lot more room to continue his asset purchasing program. If anything, he might get a bit more aggressive. All right. Like I said, the market needs it, or if not, it's going to fall. Every country will feel the ripple effects. Bernanke will continue to print to avoid this. All right. Great time to get into the market, guys. Play it carefully. Play it safe. Pay attention to the fundamentals, because none of the fundamentals have changed. We are still in a no-growth economic environment. The stocks are still rallying. They're still printing money. So, again, we have to look at the market for what it is. All right. And as long as you're careful out there, okay, keep some cash in hand. Of course, follow the basic rules of investing. Keep 15-20% of your investment portfolio in gold or silver, because this is a hedge for all the chaos that's going on out there. This is what's going to allow you to preserve your wealth if things were to hit the fan. Okay. Again, like I said, these prices can't fall forever. Your purchasing power, even if they do continue to fall, keep in mind that gold and silver never lose their purchasing power. If at $2,000 gold was buying you 10 gallons of gas, today at $1,300, gold will still buy you whatever amount of gas it purchased at $2,000. So it doesn't really matter. There might be a little bit of small fluctuations. What you're seeing is a lot of volatility in the dollar, not in commodities. Okay, guys? Make sure you understand that you'll be able to make better decisions. Now, besides that, let's get to the technicals here. I'm here. Let's see here. I'm about 15 minutes into it, so I'll try to make this very, very, very quick. So this is your Dow. I'm sorry. This is your gold market. Actually, before I do that, let me go over this chart here. Now, you can see here that since the beginning, actually the chart doesn't go back as far, but you can see here that since the beginning of the decade, really the Dow Jones and gold have been trading with a positive correlation. We did see some divergences here. This divergence lasted about 3 to 5 months. Let's see here. I think we saw the divergence here. Actually, you saw the divergence here also. Where was it? Divergence goes from here roughly to about right here, which was about a 5-month span. So that divergence lasted where gold took off and the Dow Jones came down. So that divergence lasted about 5 months. Then we are currently in another divergence right here where we took, actually the divergence began, the negative correlation began somewhere around here, and as of right now we are 5 months into this. So we're very close to ending this negative correlation and going back to a positive correlation here between gold and the Dow. Again, they both look oversold, and again, I think right now would be, especially, we were waiting for this catalyst to come, and I'm hoping that Bernanke speech on last Wednesday was the catalyst that we were waiting for. So again, we have seen the Dow Jones take a big hit, as well as gold take a big hit. So again, as of right now, the correlation is turning positive again. We'll see in the coming days if they're going to stay positive and do as the market is supposed to. Okay, this is your gold chart here. So this is your chart ever since coming back from 2003, 2002. And this is the first time I drew here a Fibonacci retracement. And the reason why is because we saw this rally from here to here. We saw this rally from $400 to $1,000, and this was a big move to the upside. This was a move from roughly 151% move to the upside. Okay, a huge move to the upside, 151% move to the upside. And then you saw and this actually was the time where all the Keynesians were saying how the gold buffs and the people that like gold were wrong, and the gold bust, and that's it, no more. And of course they were wrong. This thing continued to rally, and from there, actually from the top to the bottom, we saw a 33% decline. Okay, if you notice, the reason why I drew that Fibonacci retracement, I'm trying to make a case for this. We saw the rally, and this only retraced back to the 50% Fibonacci retracement, which is this level here. So this was when we finally found support. Yes, we did come below this support line. Okay, we did come below the support line here at 726, 727, but ultimately held up at 681. Never, ever, ever touched the 61% Fibonacci retracement. At 655, the low was 681, and from 681, it just took off. Okay, now is this going to be the case? We saw a rise. Let's see how much was the rise from here to here. Remember, it was 151% from here to here. This time it was bigger. So this time we saw 181% from here to here. Now let's talk about the decline. So the decline came from here. So far we're here. 33% here and 33% here. So again, 50% Fibonacci retracement. 50% Fibonacci retracement here. This is your 61% Fibonacci retracement over here. Like I said, on this chart, if you were trading it, it never hit the 61% Fibonacci. And this is why I tell people, never try to look for that absolute bottom. Never try to make believe you're going to call the absolute bottom. As of right now, it looks like this can potentially, if I'm looking at this over here, this can potentially come down to here to roughly 20, let's say the low 1200s, maybe 1230, 1240. Potentially it can do that. As we can see here, this is your RSI. This measures how oversold something is. This is extremely oversold. Is roughly at 23% right now, and we didn't even see this RSI mark so low back here, and we are seeing it here. So again, extremely oversold. This is the area where you're looking to buy right here. Okay. Now on my let's see here. My previous videos, I think I called the bottom at this square right here, calling the previous low at around 12 in the mid 1200s. So I'm gonna stick with that box here. I think we'll still see this box. This is your RSI again, like I said, completely oversold. Right now we are testing the 51% Fibonacci retracement. 61% Fibonacci retracement would be at 1155. I don't think it'll come that low, but as you can see, I've been wrong before. And of course, but again, we are, every day we go lower and lower, guys. We get closer and closer to the bottom. But again, it does look like this will hopefully hold up at around these levels. Let's take this out of here and look at this chart here. So again, this is a little bit more of a clearer picture. So again, this is where we're looking to have the floor. As you can see, this trend line will also help us with support over here, roughly at around 1250. Again, completely oversold, and you know, we're looking to take this thing much higher, at least on the weekly chart here. The stochastics also on the oversold side, so just like it was on the daily chart. We're looking to target minimum 1440, 1450, 1447, which is this from the 38% Fibonacci retracement. Remember over here a few weeks ago, I made a prediction that it was going to go from here. I think when it came down, I want to show you how cool these Fibonacci retracement levels are. So basically, forget about this side of the chart here. But basically what we did, we saw this move from here to the 61% Fibonacci retracement, and I predicted that from here we'll see a move to at least this 38% Fibonacci at 1424. We did see the move. It actually continued to go lower, obviously. But again, these Fibonacci retracements work very, very, very well. And as of right now, this is the Fibonacci that we're looking at. We're looking at a very long-term Fibonacci retracement with again, currently testing the 50% Fibonacci retracement. Hopefully will not be touching this level here. But again, technically it can continue to go down to this level, but I wouldn't expect it. I expect the same move that we saw here, and I expect the correlation to turn back positive. So I expect gold and silver to rally from here, and I would expect the Dow Jones to continue to rally as well from these levels. And you know, again, we could see a little bit further, more of a further dip, but ultimately I think it's a good time to buy these dips, especially in this market as well as the equities market as well. All right, so if we're looking at the 20-day moving average, the 20-day moving average is holding us on the daily chart here. If we look throughout the last couple of weeks, this 20-day moving average has been a nightmare for us. Every time we touch this 20-day moving average, it just pushes us back down even further. So really what we need to do is we need to overcome this 20-day moving average, and we need to stay above it. Until we can do that, we cannot say necessarily that this is in a bull market. So we do need to pass some of these trend lines in order for us to become positive in the long haul. But ultimately, again, the fundamentals will come to play, and obviously we're going to see much higher prices, I believe. So again, the moving averages are above us, stochastics are low. If we're looking at the weekly chart here, all right, so again, moving averages are above us and stochastics are oversold. If we're looking at the silver chart now, okay, the silver chart also looking very, very, very nice. Same situation. I explained this over in my previous video. This is your low. We saw a big dip. We're seeing the exact same thing. This actually came below your 61% Fibonacci retracement. From your 61% Fibonacci retracement, it actually took off. And it never came back, and I expect this to do the same. I expect a lot of zigzags out of here, but once we get out of this zone here, I expect this market to do a very, very nice rally, especially once we get above these $35 or $37 prices. These guys are going to continue to mess with inflation. They're going to continue to print money. That's the only tools that they have, and they're running, you know, they're running low. Their tools are not working, so they're going to have to bring in the big toolbox. They're going to have to start printing more money. So, you know, don't be fooled by the market. You know, I'm gonna do I'll do the Dow Jones analysis now. The Dow Jones right now looking very nice to buy. If you missed the rally, right now is a good time for you to start purchasing. If you start coming in here right now at the 14.6 level. By the way, today we were down, in the last month, we've been down 1,000 points on the Dow. Big move to the downside here in just a month. And again, this Fibonacci retracement, you know, again, this thing might continue to go down possibly to the 38% Fibonacci at 14.382. I think that'll be a good buy. I wouldn't buy any more until we get down to these levels here at 13.6, if that's the case. And if it turns around from here, at least you're in and you can capture the move, because I think ultimately this thing is going to come up to at least 16,000 before we see a big crash. I've said it before, this is a huge bearish formation. This is called a broadening formation, and again, this does not look bueno. I would think that this is gonna hit this market. This is gonna hit this line here sometime, and then from here is gonna take down, and that's when all hell is gonna break loose. God knows what's gonna happen. So, all right, guys, that's about it for now. Take advantage of these dips. Do not let these prices go. Don't be afraid of this market. This is just distortion. These guys are great at distortions. You see their predictions are all wrong. You know, at the end of the day, no matter where you, let's see, at the end of the day, you have to look at the fundamentals for what they are. And right now, you need to get into this market before this market takes off without you. All right, guys? Guys, be careful out there. And thanks for joining me. Bye-bye.